Welcome to my presentation on capital markets, where I'm going to compare Apple Incorporated, representing a technology firm, and Caterpillar Incorporated, representing a manufacturing firm. Here we'll examine how each interacts with capital markets, looking at their industry environments, financing strategies, and the use of debt and equity. I'll also explain how capital markets functions like resource allocation, price discovery, liquidity, and transfer influence each company. Capital markets have four core functions. Resource allocation, which is matching investors' funds to companies needing capital. Price discovery, which is ensuring security prices reflect available information. Liquidity, allowing securities to be bought or sold quickly without major price changes. And risk transfer, enabling investors and companies to manage or transfer risks through various instruments. These functions support economic growth, promote efficiency, and provide firms with financing options tailored to their needs. Apple operates in a high-growth, innovation-focused industry with significant intangible assets. It relies heavily on retained earnings and equity financing, minimizing long-term debt to maintain flexibility. This aligns with the pecking order theory, which suggests that innovative firms facing high uncertainty prefer internal financing and equity to avoid financial distress. Apple's strategy supports continuous R&D investments and protects its innovation cycles. This chart shows Apple's debt-to-equity ratio over several recent periods. The values range from 2.34 to a peak of 2.92 before declining to 1.95. This pattern illustrates how Apple's activity manages its capital structure depending on market conditions and its financing needs. The higher ratios above 2.5 reflect periods when Apple issued significant debt to fund share buybacks and dividends while interest rates were historically low. The decline toward 1.95 shows a strategic pullback in leverage supported by Apple's strong internal liquidity and over $140 billion in cash and securities. Overall, the trend demonstrates Apple's flexibility in accessing bond markets while keeping leverage at a level that preserves its credit strength and aligns with innovation-driven priorities. Caterpillar, by contrast, is a manufacturing giant with stable cash flows and substantial tangible assets. These assets serve as collateral, enabling Caterpillar to access debt financing at favorable rates. This approach fits the trade-off theory, which balances the tax benefits of debt against the risk of bankruptcy. Caterpillar uses debt strategically to lower its overall cost of capital while maintaining its operational stability. This chart shows Caterpillar's debt-to-equity ratio from 2020 to 2024. The trend starts at 2.2 in 2020 and steadily declines as you follow down here to 1.97 in 2024. This gradually in the reduction in leverage highlights Caterpillar's consistent strategy of strengthening its balance sheet while still utilizing debt effectively. Unlike technology firms, Caterpillar operates in a capital-intensive environment, so borrowing is supported by tangible assets and predictable cash flows. The small year-by-year declines suggest that disciplined debt repayment and earnings growth that increase the equity base. By 2024, the ratio of 1.97 reflects Caterpillar's balance between taking advantage of tax benefits while avoiding excessive leverage, consistent with trade-off theory. This conservative approach helps maintain its creditworthiness and supports long-term investments in heavy equipment and global infrastructure markets. This chart here is the debt-to-equity ratio comparison. It compares Apple and Caterpillar's debt-to-equity ratios for 2024. Apple's ratio stands at 1.87, while Caterpillar's is slightly higher at 1.97. The difference may look small, but it reflects two very different approaches to capital markets. Apple operates in a high-tech, innovation-driven environment. It maintains significant liquidity, over $140 billion in cash and securities, and balances moderate debt with strong equity returns. Its ratio of 1.87 shows that Apple leverages the debt, but carefully in order to preserve flexibility and support innovation cycles. Caterpillar, on the other hand, is a capital-intensive manufacturer with large physical assets as collateral. Its slightly higher ratio of 1.97 reflects heavier reliance on debt financing, which makes sense for a company with stable cash flows and tangible assets. This approach allows capital to maximize tax benefits from debt while keeping financial risk under control. The comparison shows how industry context shapes financial strategy. Apple prioritizes innovation, optionality, and liquidity, while Caterpillar optimizes leverage tied to physical capital. Comparative analysis and theoretical framework. This slide brings together the key differences in how Apple and Caterpillar approach capital markets. For Apple, the pecking order theory fits best. Apple prefers to use internal cash first, then low-cost debt and equity only as the last option. This reflects the risk of signaling the markets and the need to stay flexible in a fast-paced innovation industry. For Caterpillar, the trade-off theory applies more clearly. Caterpillar balances the tax benefits of debt against the potential costs of financial distress. Because Caterpillar has a strong tangible asset and steady cash flow, it can take on more debt safely compared to Apple. So while both firms end up with similar debt to ratio, 1.87 for Apple and 1.97 for Caterpillar, the reasons behind these numbers are very different. Apple focuses on preserving liquidity and innovation, while Caterpillar uses debt strategically to fund large capital needs. This framework shows that the best practices in capital markets are not one size fits all. They depend on the firm's industry, environment, and long-term strategy. In conclusion, Apple and Caterpillar both leverage capital markets, but their strategies differ due to industry environments and asset structures. Apple's focuses on flexibility and innovation, while Caterpillar prioritizes efficient debt used backed by collateral. These examples show that the capital market functions adapt to diverse business needs, reinforcing the role of tailored financing strategies in driving long-term success. Here are the references for this slideshow.